What's going on, guys? My name is Grant Warfield, and I'm a CPA candidate. Today, I'm going to walk you through accrual accounting. Let's get into it. Alrighty, friends, let us dive straight into it. So, the first thing that I want you to know is that accrual accounting is considered a basis of accounting. And when I say basis of accounting, I simply mean that it is a framework for recognizing economic events. And under this framework, we are primarily concerned with economic activity, okay? And the technical term is going to be economic substance. So you could think of accrual accounting as a standardized framework that basically tells you how to view or relate to and therefore record economic events. Okay, so say a transaction occurs, there could be a million different interpretations. Accrual accounting strips that transaction down to its economic substance and then tells you how to treat said transaction. Okay, now accrual accounting, as I stated, is primarily concerned with either the economic activity or the economic substance of events. And when I say economic substance, I simply mean that we are concerned or primarily concerned about when value is created or consumed. And we're not focused too much on when cash moves. Okay, that's going to be the statement of cash flows. So, under this basis of accounting, we are primarily concerned with economic performance, okay, not cash timing. And to give you a formal definition of exactly what accrual accounting is, you could think of it as a system that records economic events, okay, when value is either created or obligations arise. And that goes back to my comment earlier about value consumption, okay? We care about value creation or value consumption. And so what this means practically is that we recognize revenue when it is earned. And we're going to recognize expense when it is incurred, okay? And notice we didn't say anything about cash being received. We've simply earned this revenue, okay? And to give you more clarity on what I mean by earned, I'm simply speaking to the fact that we have satisfied a performance obligation. Okay? And when I say that we have satisfied a performance obligation, I mean that we have provided a good or a service, therefore, we have earned your money. Okay, that's effectively what it means. And so the same pattern is going to hold for expense recognition. So when we say we have incurred an expense, we mean that somebody has satisfied a performance obligation for us, therefore, we owe them. If you're anything like me, you like to understand why things exist, so let's go over why accrual accounting exists in the first place. So, the primary goal of accrual accounting is to reflect the economic performance of an entity. And the economic performance of an entity can be distinct from its cash flow reality. During any given period, a company can have positive net income and negative cash flow, okay? So, cash accounting fails to accurately reflect or report economic reality because it's primarily concerned with cash timing. And cash can arrive before value is delivered or after value is delivered. But accrual accounting says, hey, keep your eye on the ball. We care about value transfer, okay? Has value been created or has value been consumed? Because that is what's going to most accurately reflect economic activity or the economic substance of an event. To really make my point clear, let me show you this quick timeline. So we have cash versus accrual. So let's say that this represents a month. And let's say cash was paid at the beginning of the month, value was created in the middle, and cash was received at the end. Okay, these points in time represent different aspects of financial reality. Accrual accounting is only concerned about when value is created or consumed. We don't focus on when cash is paid or when cash is received. These are considered non-events under accrual accounting. We are primarily concerned about value creation or consumption at this point in time. Okay? So now let's go through a couple examples to really make these points plain. So there is a scenario where you can record revenue before receiving cash, okay? And this actually happens quite frequently. So let's say a company delivers a product today and the customer pays later. So let's deconstruct this event using the accrual accounting lens. So a company delivers a product today. That sounds like we satisfied a performance obligation. The customer is going to pay later, but we don't care about that because technically we have earned this revenue. So the journal entry is going to be recorded as follows. We're going to increase an account called accounts receivable, which is a balance sheet account. And accounts receivable, when you record that, you're basically saying that we have earned revenue, but we haven't been paid yet. So we expect to receive this amount at some point in the future. So revenue is going to go up and accounts receivable is going to go up, okay? So revenue in this scenario is going to be recognized before cash. Now let's go through this example. Let's say we record cash before revenue. So a customer pays today, services delivered later. Now let's deconstruct this accounting event or economic event using accrual accounting. So the customer has paid us, meaning they've given us cash, so cash is going to go up. But have we earned this revenue? No, we haven't provided them any good or service. We have not satisfied our performance obligation. Therefore, we cannot recognize revenue in this scenario. Okay? So cash is going to increase, and an account called deferred revenue is going to increase. And this deferred revenue account balance is going to decrease once we satisfy our performance obligation. And another name for this deferred revenue account is actually unearned revenue. Okay? And it's a liability account on the balance sheet. So in this scenario, we received cash before we earned revenue. Now let's go through a couple expense accruals, then I'll let you go. So in this first scenario, we are going to recognize an expense before we actually pay any cash. So let's say we have an employee that works for us this month. Now, the employee worked, that means they satisfied their end of the bargain. They satisfied a performance obligation. So they have technically earned income from us, okay? They've earned revenue. Now, on our side, since we're going to make good on this, we have therefore incurred an expense. And it's going to work as follows. So salaries expense is going to increase, right? Because we have incurred an expense. That person has earned income from us. And wages payable is also going to increase. And this is a liability account. And what do liability accounts represent? They represent present obligations. Okay? So in this scenario, we recognized expense before we actually paid any cash, and we're going to record the total consideration to be paid in this wages payable bucket. Okay, in this next scenario, we are going to pay cash before we actually recognize an expense. So a company prepays for insurance, okay? And when you prepay for something, you're going to capitalize that cost, okay? So let's say you pay, I don't know, $10,000 for insurance. You would initially record that as an asset, okay? We wouldn't expense this immediately. And if you want to go deeper into how the mechanics of this work, watch my capitalization versus expense video and my accounting allocations video to really understand what I'm talking about here. But essentially, you're going to capitalize this cost initially. So prepaid insurance, which is an asset account, is going to increase. And cash, since we paid for it, is going to go down. So cash is going to be decreased before we actually recognize an expense in this scenario. Then later on, as we consume this good, as we receive the benefits related to the prepaid expense, we're going to recognize insurance expense. Okay, so here is our expense recognition, and then the balance of that capitalized cost is going to decrease in turn. So what's really cool about accrual accounting is that it actually connects the income statement and the balance sheet. And I'm going to create other videos about the income statement and the balance sheet, but just know that on the income statement, this is what's going to show your profit and loss. Okay, that's what the income statement is about. And the balance sheet is going to show your financial position. Okay. And what's interesting is you start to see this as a cohesive system is that you'll notice that revenue and expense update or increase or decrease assets and liabilities. So it's really an interrelated system once you once you really get deep into it. And just to show you how this works on a cursory level, if revenue increases and expense remains constant, then net income is going to increase. If net income increases, equity, which is a portion of the balance sheet, is going to increase in turn. So net income, which is going to be found on the income statement, kind of acts as this bridge to the balance sheet here. And of course, the same relationship holds with expense. So if expense goes up, all things remaining constant, if revenue remains constant, then net income is going to be decreased. And equity is also going to decrease in turn. Alrighty, guys, thank you so much for watching. I really appreciate your time. If you don't take anything else from this video, just know that the primary purpose of accrual accounting is to reflect the economic performance of an entity. Like, subscribe, stay tuned. Thank you.